Hello, everyone. Welcome to How to Trade. I'm Shane Vernier, and this is the Fibonacci Counterpunch Strategy Workshop. Of course, on every one of these workshops, I got to get into what's happening today, and also we've got to look at our big markets. I already have a request from Bobby Bob. Kindly have a look at gold and WTI. Of course, we'll cover gold and WTI. Not much has changed in the WTI markets, crude oil. And as far as gold goes, I mean, it's been pretty good. We just missed a secondary entry on that 38% level I had for you at 27.12. We only went to 27.17. So that would have been a stretch to get in on that buy. But right now, I'm liking what I'm seeing. I mean, we sort of have an active day on Wall Street. We're getting a rally, a pre-weekend rally, and we're going to get right into trading it. So there's a lot going on in the world right now. Everybody knows it. Everybody knows the election. If you watch any of these streams, I talk a lot of geopolitics. I talk a lot of politics. But, understanding that the next 10 days ahead of the U.S. election are going to be absolutely frenetic. And also, we're going into NFP next Friday, so we've got employment numbers. I mean, it's a big time to be in the market. So good to see everybody back in the room. Ivy, good to see you. Bobby Bob, always a pleasure. Mark Corp, good to see you. JC. All right, so the title of this stream is the Fibonacci Counterpunch Strategy. Now, we're going to go over a couple of things first, and then we're going to dive into what I do and sort of explain exactly how to use the Fibonacci's, at least according to what I've developed over the past 10 years. I've had a lot of luck with these things, and it really plays into the fractal nature of the markets. But we're going to save that for later. Let's get into a few other things that we need to talk about first, sort of get them off our front burner. First thing I want to point out is this is a trade idea that I posted on X last night. If you don't follow How to Trade on X, be sure to check it out. When we see something, we try to get the trade idea out there. The whole point is to get you guys trading and understanding what's happening in the markets as much as we possibly can. So with X, it's a great platform. I can just pop in and post a trade idea if we see one. This was an interesting trade for all you 9 EMA traders. There's a lot of you out there. This is 9 EMA with RSI confirmation. This is something we've been covering a lot in the last few weeks. And this was a trade that came across the board last night. I thought it was a pretty darn good one. You can see right there, we're in oversold territory on your RSI. We're beneath that 30 threshold. And what does that tell us to do? It tells us to buy the market as soon as we cross over that 9 EMA. So we've got our 9 EMA right there. There was our bullish break. We bought right there, and now we're just sort of riding this thing out to the profit target. Now, you'll notice that I'm using a 4-hour chart. Now, when we've been scalping with that 9 EMA strategy, we've sort of been using real short time frames, real compressed time frames. I highly recommend looking at a 4-hour chart for the Forex. I really do. Why? Because the ranges aren't that big even in the 4-hour chart, and the Forex is truly a 24-hour market. So if you're interested in maybe starting with the 9 EMA with confirmation, I know some of you are. Some of you trade that way. Boy, I'd be looking at Forex 4-hour charts. That's for sure. And as long as you don't have a big key economic event, you can get in on these trends. And this looks like it's a pretty good trade. We bought here. Then right appears our profit target. Why is the profit target there? Market structure. That's the only reason why. There's nothing special about these numbers up here. It's just market structure. So we're shooting for a profit target there. Our stop loss is very reasonable. I mean, this is a pretty darn good trade. I'm watching this one closely. I think it's going to cash in. If not, probably not today, but maybe early next week. I like what's happening there, though. That's a pretty darn good one. As far as the gold market goes, it's been fantastic. We're actually going to apply our Fibonacci's to gold here in a second. We went right up to 27.50 and sort of got that dirty rotation. That's what I call it, dirty rotation. That's when the buyers and the sellers just sort of knock heads, and we can't move the markets. We can't move the markets at all, and the reason why is typically there's a big number, and there's a lot of sellers that are trying to pick the top of the gold market, retail guys like me and you, ladies and gentlemen. The reason why is because it's cheap. Think about it. Let's say I showed up and I sold 27.50 saying, okay, this is going to be the top of the gold market, and I wanted to risk $10 or $20. And I dialed my leverage down and said, no, I'm going to get the big retracement back down to 22.50. That's what a lot of retail guys are thinking because it's cheap. Is it a good trade? No, you're fighting a trend. You're probably going to get eaten up. Remember, the market always eats up scared money. So when you go into a trade and you're kind of trying to make it as cheap as possible, most of the time you lose. We're going to apply the Fibonacci's here and show you a few key levels here. One of the things that we're going to be doing on the short time frame here is going to be your E-mini NASDAQ futures. You can see the NASDAQ is out of the gate. It's rocking and rolling. Why do you think that is? Tesla's blown the lid off of this thing. So we've got Tesla rocking. We've got, I believe, Palantir was a big stock yesterday. I saw the gentleman on CNBC. He was talking a lot of smack. That was a big stock. You've also got, of course, the staples, NVIDIA, and they're all showing strength right now. So right now, the NASDAQ's got a lot of bidders. And if we were looking to do our Fibonacci counterpunch, we're just looking for a nice spike low, and right there it is. And we're looking for this market to sort of base out up here and then buy the retracement. And I'm going to show you how to do that in just a second. And then for U.S. oil, we're going to cover this one as well because we do have a little bit of action, about 1.3%. Our trend line, I was really optimistic we were going to get a shot at our trend line. I'm not a trend line trader, but that would have been too good to pass up. So right now we're rotating inside of yesterday's range, and we've sort of topped out near an EMA and a Bollinger midpoint. So a lot going on in the markets. I think we're going to get into a couple pretty good trades right here, and we're going to look at some others. Anything that's moving in the short term, we're going to be trying to trade here on a 1 minute, 5 minute time frame. Just looking at this chart, if we do get a pullback right here, we'll have an opportunity to do it. And I know I haven't gone over my rules just yet, but that's what we're going to be looking at. We just need a pullback from this high, and that would be our entry. Right now we're trending. 5 minute chart's trending for the E-mini NASDAQ. We're going to be looking to bid right above that 38%. So that's sort of a preview of what we're going to be doing here. As far as, what we need to really do here before we move any further is cover our durable goods. That was the big number that was out earlier today. Durable goods came in actually negative 0.8. Not as bad as we thought it was going to be at negative 1. Previously, we're sort of flatlining here. Everybody's trying to figure out if we're going into a recession or not. Durable goods didn't help us. It just didn't help us. So what I see happening here is a lot of debate about the policy, about what the guys are doing at the Fed. Are they cutting rates? Is that the right thing to do? Are they going to keep cutting rates? I don't know that. I don't know that for sure. And I'm not really ready to bet the farm on a weaker dollar just yet, just because a lot of other folks are cutting rates. And if the Fed doesn't keep pace, that's going to make for a stronger dollar, and it's really going to skew all of our markets. So we're watching that relatively closely as well. All right, guys, let's go ahead and get down to business here. This is the Fibonacci Counterpunch strategy. I'm going to go through it. I'm going to show you where to find it. A lot of you, I get this question a lot after some folks watch the live streams. It's not in our strategy section. It's going to be down in our elite trading series. So if you go right down here to the bottom, now your screen may be a little bit different than mine, and that's okay. We do have several different versions of this, but if in fact this is your screen, the strategies that we trade typically a couple times a week are up there. And then you've got our other courses. That's our academy. And then right down here is going to be your elite trading series. And you're going to see right there 7 modules, 13 hours, 39 minutes. And you're going to get this screen right here. Just click to move me to a new path. And then we're going to come down. And what are you going to have right here? You're going to have a bunch of videos, a whole bunch of videos on the right side. This is the elite. This is the elite trading series. You're going to go down to module 3, the Fibonacci Counterpunch. And those are the 6 videos you're going to want to look at. So right there. So the whole point is you're going to click on the first video, and then you're rocking and rolling. I mean, that's it. That's me. Now, why do we call it the counterpunch? Why do we call it the counterpunch? Because with Fibonacci retracements, they're like a measuring tape. We're waiting for the market to move, retrace, and then we're going to trade it. I'm waiting for that initial move. That's what we have in the NASDAQ right now. We have an initial upward pressure. We're waiting for the market to come back down to us, and we're looking to either buy the market at a discount or sell it at a premium. That's what we're looking to do. Now, that's the whole idea, is the market throws a punch at us, we slip it, and we hit back, and that's the idea. That's how we make our money. I always find that it's better to react to price action as opposed to anticipating it, because if we anticipate the price action, we get into trouble. That means we project on the market, and we have a real problem figuring out, A, how far our market's going to go, and B, is it going to go up or down right now? Remember, we're retail traders. You're not Warren Buffett. You don't have staying power. If the market comes off right now and we're long, we get hurt. If the market goes up and we're short, we get hurt. We can't ride these things out. We simply don't have enough money. So the idea is we want to watch the market commit, and then we're going to react to what it does. That's the idea behind a counterpunch. So a lot of you that are boxing fans out there probably understand exactly what a counterpunch is, but that was sort of the reason why I chose that name for the strategy. So you can see right now, we're still watching this NASDAQ 5-minute chart. If we do, in fact, get a pullback, we're going to be looking to bid this thing. So why would we be looking to do that? Well, there's a couple of basic rules with this strategy that you're going to need to know. And full disclosure, I don't trade Fibonacci numbers like pretty much anybody else. I don't do it. And a lot of it comes from experience. A lot of it comes from what I was taught when I started. I was fortunate. I had a mentor that made his bones on Wall Street and traded Fibonacci numbers for literally 30 years. And so when I was told certain rules as a new beginner, I took them to heart. I didn't argue with him. I said, well, you're the guy with $5 million in the bank, and you're the guy that's been doing it for 35 years. So what I'm going to do is focus on what you're telling me and say thank you. Now, I had some partners that didn't do that. They wanted to argue, and they wanted to argue about it, and which is fine. They may have been correct. For me, I wasn't interested in arguing. Didn't really care about the whys. I wanted to know the whats. I wanted the what was making money. So this is what we sort of came up with. This is what I was taught, and this is what I've been practicing for the last 11 years, actually longer than that, since 2011. So 12 years, 13 years. Boy, time really slips away from you for a while. In any case, this is the Fibonacci Counterpunch. All right, the premise is to capitalize on retracements in price. We're waiting for the market to move, retrace, and then we're going to get long or short with the prevailing pressure. Now, you can trade it on all assets and all time frames. Some time frames are better than others. What will make you successful is being able to manage your money and manage your risk. That's all there is to it. That's the bottom line. It's the bottom line with any strategy. In any case, key levels here, 38, 62, and 78. Those are my tradable levels. All right. Now, no 23.6. I don't trade that. I watch too many people lose too much money trying to bet on 23.6. Now, I had a devil of a time explaining this to the Business Insider folks when we did a piece on this strategy last spring. They didn't believe me. They said, you don't know what you're talking about. 23.6 is the best. And I said, no, I don't do it. I don't do it. I'm not interested. The retracements aren't deep enough. You get chopped up way too much there. But if you want to trade it, you go right ahead. 50%. I also don't do that. I don't do 50% either. You need supporting evidence. Now, I'm coming around on 50%. If you're trading a rotational market, something like the Euro USD, or maybe even your E-mini S&P 500, I see 50% get hit a lot in work. So if you like 50%, I'll allow it. Just understand that those are huge public numbers. 23.6 is like 25%. So you're basically talking about 25 and 50%. I call those very obvious. I want the market to prove itself. So I want 38 and 62. 78 is the point of no return for me. Now remember, our objectives here, we're not calling market reversals. I have no interest in calling tops or bottoms or taking positions. What we're looking to do is to scalp, all right, and to get in and out with short-term positive trades. That's what we're looking to do here. Now, we want to quantify a useful range. That's the first thing we want to do. Now, that can either be time-based or that can be a spike to spike, all right? I'm going to show you an example of both, and then we're going to dial in for our scalping day and swing entries. That has to do with risk versus reward and also the time frame. All right, let's go ahead and have a look at what's really important here. Now, to use Fibonacci numbers, it really is all about market state. If you try to use Fibonacci retracements in a flat market, you will lose. We can bet on it. If the market gets flat and choppy, you will lose trying to bet retracements because the market's consolidating. There are no retracements. It's a saturated area. There's bidders and sellers at every level. It doesn't matter. There's no meaning in the price action. In geometry, we call that fractals. We're looking for fractals. We're looking for something that's big, and then we're looking to get in on smaller moves that reflect the larger sentiment. In a choppy market, you don't have that. You don't have that. So what happens is you start taking buys and sells and you flip your positions, and it's terrible. You don't want to do it. We want a nice, clean range. All right. Now, remember this. The trend is valid when price is above or below 38%. So just a quick look. This trend is valid right here. Okay, the uptrend on this 5-minute chart is valid because we're still above 38%. Now, what we're looking to do here is get in on a pullback. So we're looking to get with prevailing price action. So if I was going to look to do this, I want to buy limit order, and we're just going to have to execute this, and I'll finish explaining in a second. 26.15. Let's go 26.15, something like that. 26.16 and a quarter. We're going to shade our entries a little bit above support and a little bit below resistance. The reason why we do that is because we don't want to miss. Now, our take profit and stop losses, clearly we're not going to do 75 ticks. I tell you what, let's just go 20 ticks, and then we'll go 20 ticks here on our stop loss. So let's go ahead and get our buy limit order in the queue, and right there we are. Essentially, that's going to be our trade. All right, now let's get back to sort of, I had to do that just in case our trade went. In any case, let's see, Mark Corp. Where is the 50 to 62% range? Does the golden zone begin? Yeah, the golden zone is something. We'll cover that in just a second, Mark, but good question. We'll go back to the chart here and cover that. But in any case, this is what's very important about Fibonacci's. Now, remember, the trend is valid if you're above or below 38 and 62. Now, the trend is strong when price is above 38%. So right now, on our E-mini NASDAQ chart, the trend is strong. Now, remember, it's a 5-minute trend. It's strong. We have to assume it's strong because price is above 38%. Now, technically, the trend is technically valid, but maybe not as strong from 62%. Okay, so as long as price is above 62% or we come down in here between 38 and 62, the trend is still valid. The uptrend is still valid. It just isn't as strong as it was above 38. Now, to answer your question, Mark, the golden zone, Fibonacci golden zone begins at 50% and goes down here to 62%. So if I was going to enter based on a golden zone trade, a lot of times I'm looking for confirmation right in the middle. That's fantastic. Maybe a chart pattern. Maybe I just step up and buy in the middle there. There's nothing wrong with that. I don't like to be super aggressive with the golden zone at 50%. I'm not interested. Now 62%, that's a great trade for me, and that's a tradable level in my view, and that's one that I really would jump all over. Love 62%. 62% is pretty good. You don't always get it though. That's really hard. Waiting around for those 62% can be very, very difficult, especially if you're scalping like 5-minute charts. All right, now lastly, understand the importance of 78%. 78% is absolutely huge in the markets. Absolutely huge. It's the line in the sand. All right, it is the line in the sand. If 78% goes right here, our 78% level, if that thing goes, that means that we're going to run at our swing low. So I know folks that do shorting strategies. As soon as 78% is taken out, they look to just go after the swing low. So on a buy, you'd be shorting here, and on a sell, you'd be looking to buy there because the odds are once that 78% is gone, the swing low's gone, our one level's gone. All right, now let's talk about drawing these things a little bit. Very, very important that you understand how Fibonacci's work and what they tell us about market state. Absolutely crucial. All right, let's see right here. This is how I like to build my Fibonacci retracements. The most recent spike to spike, okay? Now, what's a spike? A spike essentially is going to be either a swing low or a swing high. Now, the more obvious they are, the better. This is what gives us our market structure, okay? So you've got a spike low right there. That's going to be your swing low. Now, essentially what a spike is it's a 3-candle pattern. That means we've got a candle here. We've got the second candle is the lower extreme, and the third candle is above that second low. That's all a spike is. Very, very simple. That's all it is. That's a spike low. This is an obvious spike high. You can see the first candle sort of comes up a little bit. Second candle, upper extreme, the top of the second candle is our spike. And then the third one, you're going to trade beneath that spike high, or excuse me, that top right there. That's your 3-candle pattern. That's all it is. Very simple, guys. Now, I like to do the most current, especially if we're going small time frames. I like to do the most current spike to spike. That's what keeps us relevant. That means that we're trading current price action. We're trading right now. We're not trading what was. All right, that's important. Now, there's a couple of ways to build these. This is the way that I rely on. Most current spike to most current spike. One last thing before we move on and start trading. You can see right here. See how this top right here, and we flatlined? That type of thing right there is what you do not want to apply Fibonacci's to. If you get into that kind of that kind of market conditions, you're going to lose. You're going to lose. You're going to get chopped up because the Fibbies don't mean anything when the market's saturated like that. Okay, our trade's coming to us. All right, right here. What do we think about our entry point? I like it. I think it's pretty good. Now, is it high risk? I see it as being this time of day on a 5-minute chart. It's not as good as, say, my daily ranges or my longer-term ranges, my longer-term numbers, but I still like this trade. Now, right now, it's about 8:15 my time, so 10:15 Eastern, 10:17 Eastern. We're right in the meat of the U.S. Open. There's a lot of volume down here. You can see the participation's high. We've got our lower spike right there. That's our low. Okay, that's our swing low right there, that middle bar. It doesn't go very much past this one here, but it's still valid. So I'm going to go ahead and go there. That's the beginning of our trading session. All right, 9:30 a.m., opening bell, ding, ding. You see our volume picked up. And now what's happening? We had a nice big run up right there to the doorstep of 20,700, and now we're starting to sell off a little bit. So what we want to see here is we want to see this market give us a nice swift hit. We would love it right here in the next minute 30. That would be fantastic. We're just still a few ticks off, about, 20 points, 30 points. Believe me, the NASDAQ can make that up at the drop of a hat. So I'm going to go ahead and I'm going to leave this one. We're not going to sit here and wait on it, but that's what we're looking to do. Get with that bullish pressure. The buyers were there. The buyers are still winning the battle today, but right now there's some sellers. There's some profit taking from intraday traders, and now this thing's coming down to us. We've established we have bullish pressure. We've got our entry point, and now we're looking to enter. That's all there is to it, really. That's the counterpunch. Now, we're going to talk about some other concepts, longer time frames, and we're going to see if we can get what I call commonality And that's when we can get levels to converge. That's in one of those videos that are in the Counterpunch strategy. I go through and I show you exactly how to do this using multiple time frames. That's what makes this thing really sing, is when you have multiple time frames and you start to get that overlap in the Fibonacci's. That's where you get real strong support and resistance areas. All right, let's take a look at gold. So for me, gold, I'm looking at this, and we are sort of we've nailed gold. I'm very, very happy with the returns off of the gold market. But right now, let's take a look at our weekly time frame. Beautiful swing low, nice swing high, something like that. Okay, we know we've got robust support at 27. If we get a shot at 27, you got to show up with handfuls of money. I mean, that's the trade. That's the trade. Probably put that out a little bit later today. That's a pretty darn good trade. Now, as far as what can we do on shorter time frames to maybe improve our chances of getting into a trade? Well, remember, we start with our long time frames, we move to short. As we move to the short time frames, you're going to have an opportunity to trade. There's no question about it. It just depends on how short time frame you want to get to. Let's go from here to a daily. What do we have on the daily? Okay, the daily, we could go from this spike to this spike. This was the entry that we used earlier. Remember that buy right there? It's pretty good. Now, this question right here I get a lot too. He goes, Shane, what about one candle? I go, what about one candle? He goes, well, that's a swing high. That's a spike high, and that's a swing low. That's a spike low. And I go, yeah, what's your point? Do I want to run a Fibonacci from there to there? No. Why don't I? Because the market's flat. That's a disaster. See that? Do I start here? Do I go here? Do I buy it or do I sell it? What do I do? Stay out of that. You don't want that. You want nice, clean, clearly defined levels. That's all there is to it. Obvious, guys. The 9 EMA, we've been talking about that a lot. I want obvious. I want it to be obvious. The Bollinger W with the big green candle, I want it obvious. Things have to be obvious. There's too many markets and too many time frames to try to do something that's a little bit sketchy. You don't need to do that. Make it obvious. Things should be obvious. If they're not obvious and you're like, I don't know, well, I'm going to take the trade anyway, you're probably going to lose, not because you're wrong, but because you don't really believe in what you're doing. Obvious. I want nice, clear-cut highs and lows. That's a beautiful spike low. That's great. That was fantastic. So when we're looking at something like this, I'd say, okay, can we get anything that's going to help us? Let's go to a 4-hour. It's going to be hard. Let's chop. Let's go to a 30-minute. Okay, we got a big 30-minute bar right here. It looks like we're breaking out. Let's go to a 5-minute. Got a little something here. Remember the rules. Spike low, swing low, piece of cake. Spike high, swing high, piece of cake. What's your entry? 27.33, somewhere in there, 27.33.75. Shades your entry. I mean, you could probably go at 34 if you want to get long and you're aggressive to the top side of this market, but that's your trade. So if we're going to build this trade, just theoretically, if we're going to build this thing, how am I going to align? Number one, what does my entry need to be? I highly recommend on 5-minute and 1-minute charts, you go as close to that line as you can because they're more volatile. Odds are your number's going to get hit right on the nose. So right there, 27.33.71. Let's just go ahead and shade at 10 cents. Okay, so let's say that's our entry. All right, where would my stop loss be? Now, there's a couple of different ways to do this. You could go beneath the golden zone, which is pretty good right there. So that's a $3 risk, something like that. Do I want to do that? Well, if I do that, I need to at least get a 1-to-1, which means you're going to have to get 36 up here. Is it doable? Yeah, it's doable. What are my odds using? Should I do that using a 5-minute chart, though? You could also go beneath the next big round number. So you go right there, 27.33.81. You could put your stop loss right beneath 33, something like that, maybe 32.71, and risk maybe $1. You could do that. You could risk just a flat portion of your trading account. You could say, okay, I want to risk 1% on this trade. I have a $3,000 account. 1% of 3,000 is what? $30, I believe, something like that. Okay, so if it's $30 and I have $30 to risk, you say, okay, I want to make $30 and I'm going to risk $30. So I'm going to throw down on my level and that's a wrap. I'm just going to let this thing go. Okay, I can buy into that too. If you're going to risk percents, though, you don't have to trade a 1-to-1. You could trade a 1-to-2 or a 1-to-3 on this strategy. It is a trend-following strategy. We're trying to go with the trend. So there's nothing wrong with trying to go for longer risk versus rewards, longer rewards. Just remember that your winning percentage is going to be much lower. That's all there is to it, guys. You go 1-to-2, 1-to-3, 1-to-4, 1-to-5, your winning percentage is going to be lower. Now, long-term, you may be more profitable, but I'm not going to BS you. If you go for try to hit those home runs, especially with this strategy, sure, you're going to get in on some hot trends. I'll show you an ES trade earlier this week that was an absolute banger that really called the bottom of the market. How often do you catch those? Do you want to be sitting around for 2 or 3 weeks trying to catch one of those big winners? Well, my big winners pay for all my losers and then some. Yeah, but what if you lose 5 times in a row and you don't have any money left? That's what this game is all about, being able to establish consistency. Now, if you can consistently use something like this and hit 1-to-2s and 1-to-3s and 1-to-4s, you're going to be rich, and it's going to happen very quickly. But if you can't, and I don't know many people that hit those 10x trades very often, they may do it for a year, have a great big year. I see those guys all over YouTube. Is it real? I don't know. So as far as dialing in your risk or your profit target, I mean, I can tell you how I would trade this. Right here, 33. Let's say we're going to go long at 33.81. I would go ahead and put my stop loss right in here. The problem with risking too much on these trades is that let's say we get stopped out right here. Do I turn around and take another shot in the golden zone? Could. Or do I just get rid of the trade in general and go on to the next one? These are hard decisions, guys. Now, I've sort of shown you my entry rules and how to break down a market and understand if it's trending or if it's in rotation and how to apply these Fibonacci retracements. Sort of showing you some of from my experience. 25%. If you're trading 25% right in here, you're getting chopped up. 23.6. Personally, I'd say, okay, 33.80. Let's go ahead and put our stop loss right in there. $31.74. 33.81 to 31.74. I'll spare you the math. What is it, $2 roughly? So we're going to be looking for 35s, something like that. You could do that. That'd be your trade. On this futures trade, we just sort of used a flat 20 to 120. Why did we do that? Because this market's big. This market's big, and you don't want to get caught really taking a huge draw. That's an expensive loss. That's an expensive loss down there. All right, so what happens now? We had our Fibonacci's drawn. We had our level in play. What happened? Well, we just pushed the new top. So what do we have to do? Start all over again. Get rid of our order. Is it still as good as it was? No. Look at your next Fibonacci sequence. Spike low, spike high. Is that range right there as good as our opening range? Not a chance. Not a chance. That right there is a good opening 30-minute range. That's the one you wanted. Right here, a little bit of a pullback, and now what happens? Well, we got 10 minutes worth of pressure. We're pushing daily highs. Our pullback here, would it have been good to play 38% from there? No. It's not a big enough range. Could you have played the golden zone? Depends on where your entry was. If I was going to trade that, it would have been a deeper retracement. I would have been looking probably for that 62 right there. But, didn't get that either. Remember, they pay us to wait. They don't pay us to trade. Let's go back to gold and see if that one's gone. Okay, this one's coming our way. So right there, 5-minute chart. There's our entry. We're just going to visualize this one. We don't need the DOM going. Right there. There's your entry. There's your profit target. There's your stop loss. The number one rule, the cardinal rule of trade in this strategy or any strategy is if you're on short time frames, 1 minutes, 5-minute charts, you need to get out of these trades. You need to know when to cut a loss, because if you get caught up in a big sweep, you can lose a lot of money trading a 5-minute chart. Full disclosure, I got hit pretty good Wednesday. I had a tough start. Was down big, came back, fought up, was up, having a nice day, and then gave back the winnings on a 5-minute trade on the ES, a Fibonacci trade like this. I was lucky I got out when I did, though. If I didn't take my loss, My account was gone. That's the way it is if you're going to scalp. So something like this is interesting. We're going to be watching this one. Okay, I do want to show you the ES trade. Let's take a look at our, here's our 9 EMA trade. That's still going pretty good. And one last thing I would say about this 9 EMA stuff, you can combine your Fibonacci's with this 9 EMA and RSI. So let's say, let's say I had a buy signal. Okay, there's our confirmation. There's our bullish close. We're looking to buy in here. What if your Fibonacci's lined up to where you got an opportunity to buy at a better price than, say, than your bullish close? Could we do that? Could we do something like this where you get some extension and then all of a sudden you have an opportunity to buy from the 9 EMA convergence with the 38? It's a pretty good confirming tool, especially if you've got your RSI working, your 9 EMA, and your pullback. I'll sort of leave that up to you guys, though. Remember, creativity is important. It's your number one asset as a trader. If you don't have creativity, you could be in trouble. You got to be able to see a lot of different outcomes. So just remember that. That's a pretty good tip there. Now, as far as U.S. oil goes, let's see. We're running out of time here. Let's go ahead and take a look at the U.S. oil market. Our trend line is still very much alive. We're rotating right now back up into yesterday's range. I wouldn't do much of anything. If I was going to be game planning here for WTI crude, we've already sort of got our trend line buy down there. Well, what can we look at for next week? We've already got our trend line. There's your counterpunch. Spike high, spike low, pullback. 38% was money in the bank right there. 72.12, 72 sells, killed it. Absolutely killed it. It was a great trade. What was your high right there? 72.30, and since then you're off, what, a couple bucks? Pretty good level right there. Let's go ahead and go to our daily, see if we can find something a little bit better. Not really. If you wanted to work sort of some of that convergence I was talking about, spike high right there to a spike low. 50% of the daily. Remember, I don't trade 50 in isolation, but with confirmation, absolutely. Call that commonality. That's where those levels coalesce. They come together. Take a look at it. 50%, 72.22. You've got 72 flat. We've got 72 and a quarter right there. That area between 72 and a quarter and 72 is big for WTI. Now, it looks complicated. It's not. Once you do it a few times, you'll say, okay, what do I have lined up here? Well, I've got 38%. I've got 50%. This has worked like a charm. 1, 2. Would I do it a third time? Yeah. I could get this question as well. Shane, would you sell 38% on the daily again? 71 and a quarter. I'd be careful. That's saturated. We've traded that, 4 days in a row now? Odds are we're going to blow past that. We're going to take out 71 and a quarter. Right now we're printing 71.15. You could hold shorts right now, but I would be very careful and I wouldn't do it. I think it's high risk. I would wait. If we get some really great late day extension, I mean, to be honest with you, the trade is this. Wait for that bullish break later today. Bang, you're going to be looking at 72. You're probably going to be selling 72.10 somewhere in there, wherever our level was, 72 flat. That area right there is going to be your sell. That's your sell. Where would your stop loss be? Yesterday's high. Yesterday's high is right there at 72.30. You could sell right in there at 72, 72.15. If you wanted to be very, very tight with it, you could wait for 72 and a quarter, sell that, stop yourself out up here, though. Expect a washout above that zone. And if, in fact, we do take out yesterday's high, odds are you're going to be going back up here. Now, if we back this thing off sort of to our weekly, take a look at what's happening again. I'm going to break this down one more time because this is what I'm looking at for crude oil next week. Okay. There's your 2-week range. We've sort of bought back into that this week. 50%'s up there at 73.33. Let's go back down to our daily. You'll notice that I'm not putting Fibonacci's in here from that spike low to that spike high. Why? Because the market's flat. It's almost like a pennant formation. You stay out of those. Use Fibonacci's on those, you will lose. Believe me. Believe me. Take my word for it. Okay, that area right there is what we're targeting with that sell. Look at what you got up here, though. 62% the back end of that golden zone up there at 73.18. And look at what you have. You have that 50% on the weekly. I mean, the support and resistance levels here are sort of coming together from the weekly and the daily. And as a trader, as a long-time trader, I like that a lot. I like that a lot. That makes me a lot happier than a 5-minute chart. I would much rather bet the ranch on a level like this where I know I got about 25 pips, maybe 50 pips. I'd rather bet the ranch that stuff holds up or wait for confirmation and take a position than sitting around trying to trade a 5-minute intraday chart. You don't get as many trades, but boy, when you get a level, take a look at what we've got on that level. 1, 2. I mean, those are really rock solid trades. Something to think about there if you're interested in getting into the finer points of the counterpunch. This is what makes it sing. When you get those levels to line up, that's what takes the efficacy to the next level. All right, let's go back and take a look at our gold trade. You can see we didn't quite get our pullback, and now price is rocking up. That's frustrating. That happens a lot on short time frames. It's part of doing business. As far as the NASDAQ goes here, you'll notice what's happened. Now we pulled back, and now we're sort of flattening out. I'm not interested. I don't want any part of this now. Why? Because the market's flattened, inside bar. Now we sort of got a head fake to the top side. I mean, you could take the long right here and just say, well, we're above 38%. Let's go long and see what happens. All right, we're up a few bucks. Is this dependable? I mean, it's with the trend. You could trade it like this as well, not worry about your entries and just trend trade. A lot of traders do that. The problem is that my trade location's not great. I essentially have bought the top of the market. Yeah, we're making a little bit of money, but is it a fugazi? Can we consistently buy the tops of markets and win? No. Can you sell the bottoms of markets and win? No. That's the idea behind the counterpunch. We want a better price for everything. We want to wait. We want to get a better price than the competition, and then we want to take their money. That's it. That's all there is to it. So can we make money doing this? Maybe for a little while, but eventually these markets will reverse, and you'll end up buying a top or selling a bottom, and that'll get very, very expensive. All right, one last one. Let's see. We're not going to get that gold trade. I do want to show one last level, though, that really speaks to this is E-mini S&P 500 futures. It's basically the same chart we were looking at on the NASDAQ. The price action's been the same. You see you didn't quite get that action there, didn't get that pullback. But what we did get earlier this week, and this is a weekly chart, and I get a lot of people say, Shane, you can't afford to play a weekly chart. Bear with me here. Okay, right there. What's your low? 57.24. What's your low there? 57.25 and a quarter. 57.24 was what? Spike low. Upper extreme, all-time high. Now, this kind of stuff right here is where you make a lot of money. And this is what traders look for, especially retail. Look at the back end of that golden zone. Spike low right there, right around 58.01. 58.01 and a quarter. What was our low? Our low was 58.01. That trade right there is very cheap. You put your stop loss at 57.99, 57.98. 10 ticks. Look at the rally. You're up 95 points. That's insane. 94 points. So sometimes these Fibonacci's, boy, when they hit a home run, they hit a big home run. Definitely there. All right, guys, looks like we're sort of out of the game, and that's one reason why you don't try to buy tops, because now the market's coming off. The market structure is completely broken down on the 5-minute chart. This kind of stuff, you've got to have good entries. Now, down here, you could probably make some money at that 62%, but just buying the market willy-nilly, you don't want to start doing that. That's a bad habit. All right, everybody, thanks for joining me. That's the Fibonacci Counterpunch Workshop. Honestly, there's some nuance, and there's things we could talk for hours about it. As far as WTI, I think we showed you some pretty good levels for U.S. oil. I would be focused on those next week. As far as gold goes, gold's still bullish. Silver still bullish. Big time week. As far as equities go, you're seeing some bullish price action right out of the gate. Be careful towards the close. We could definitely give back some of those gains. I don't know who's going to go home long equities today. I really don't, but somebody out there will. All right, everybody, thanks for joining me today. You have a fantastic weekend. From a scheduling standpoint, I'm out Monday and Tuesday. It's hunting season here in Montana, so I'm going to go hunting, take my dad hunting. Should be a lot of fun, but I'll be back in the saddle Wednesday. Connor will have you covered Monday and Tuesday. All right, everybody, thanks for joining me. You have a fantastic weekend. Close strong, trade well, and we'll talk soon. See you.